How does the turmoil affect this call, not from the from the perspective of politics, but from the perspective that it could bring Republicans and Democrats closer together to focus on what they would rather focus on right now, which is policy, rather than high drama at the White House?
Right. No, I think that's exactly right. So I think, the idea of a blue wave, or, it's not really a wave, it's more of a ripple, but, a Democratic sweep is essentially coordinated policy. You can get more done. I think what's interesting right now is that you've got this petri dish that sounds really great, right? You've got growth accelerating off of a very low base as we come out of an economic recession. We've got coordinated policy. That means that we might see more fiscal stimulus than we were expecting under gridlock. We've got this environment where rates are still low enough that nothing looks dangerously, kind of the cost of capital is still incredibly low. So that all seems really bullish. The reason that we're not as bullish on stocks is the market has arguably anticipated a lot of this positive, news flow. And I think at this point, if you look at a lot of these sentiment barometers, sentiment looks pretty bullish. And as we all know, when sentiment gets really, really bullish, that's about time you want to think about toning down your allocation to stocks. So, amongst the variety of sentiment measures that we track within Bank of America, Wall Street strategist allocations to stocks are higher than they have been since the global financial crisis. We've got an environment where cash positions of institutional investors are, low enough to suggest that there's positioning is full and there's more downside than upside risk to stocks. So, I think when you look at everything, to your point, we've got an environment that seems like it's going to be good for the economy. But I think this administration doesn't use the stock market as a barometer of success or failure like the last administration did. And that means we could be in for an environment where policymakers are more focused on the economy and real inflation and, better wages rather than just asset inflation. So I think that's the kind of the interesting push and pull right now, is thinking about that trade-off between a better economic environment and what happens to the S&P 500 in that scenario.
Savita, I love there was one example of froth in markets of a SPAC, a special purpose acquisition company, that was named LMAO. That was its trading ticker, and it filed and to raise money. So where do you sell? Where do you see the biggest froth where you say it's time to get out?
Look, you know what I think you do this year? It's not necessarily a year where you want to sell everything, because like I said, we've got a pretty good environment. We've got a vaccine, we've got growth. But I think the trick is what you buy and, what you lighten your exposure to. So, you mentioned earlier, we like value. I think value is the place to be as we start to see this vaccine percolate throughout the economy, as we start to see reopening. I mean, what's interesting to me is that investors have not shed their huge overweight in growth stocks, despite the fact that we all know we're in for a broadening out of the economy, and the playbook would tell you to go into value stocks. It's been such a long period of time where growth has had such consistent leadership that we're kind of in those 1999, early 2000 levels of tech is what you want to buy forever. And there's just this incredible sentiment and embedded positioning in growth stocks. So I think the value is still a great place to look towards rotating into. Financials is our top pick. And, we saw massive moves in rates over, just over the election results. And our view is that we see a little bit more upside for interest rates. We see better long-term growth assumptions. A strong dollar doesn't necessarily hurt financials. So to your earlier comments about currency, I think a good hedge against, what if the dollar doesn't weaken, is the idea of exposure to financials over other areas of the market.
Savita, when we talk about the influence of Washington, D.C., there's a question of what type of stimulus effort is being priced into markets based on the consensus view that there will be a stimulus in the next couple of months. Henrietta Trey's of Veda Partners was coming out this morning and saying that we could see stimulus of up to $1.8 trillion. Is that priced into markets right now?
I don't think it is, and I guess it depends on where the stimulus is geared towards. So I think if you're thinking about stimulus like an infrastructure bill, I would argue that's not priced into the market, because if you look at sectors that would benefit from a traditional CapEx cycle, I mean, you have a little bit of a move in industrials, but energy is still trading at relatively inexpensive levels. You've got an environment where, cyclical beneficiaries of CapEx aren't necessarily trading at such lofty multiples. So I think that, where the infrastructure is spent is going to be interesting. Where the stimulus is spent is going to be the tricky question. I also think the area of the market that hasn't necessarily re-rated on potential for friendliness from DC and more money spent is healthcare. And if you think about it, healthcare is at the epicenter of this crisis. We've seen corporations commit more to their employees. We've seen the government and the Biden administration more focused on kind of controlling coronavirus. But healthcare has been remarkably flat in terms of performance relative to the market, just on fears around regulatory risk. So I think there's some opportunities within healthcare, within some of the CapEx beneficiaries, to see more juice, if you will.